If you think the silver crash is over, and if you think what just happened was normal market behavior, then you're already behind. Because right after silver slammed lower, the CME quietly stepped in and raised margins. And if you understand what that really means, you'll realize this move might not be about controlling risk at all. It could be the spark that triggers the next explosive move in silver. Most people are looking at the price chart and missing the real story, but what's happening behind the scenes right now could change everything very fast. Before we go any further, make sure you hit like and subscribe right now, because this channel breaks down what the headlines don't explain. On Silver Shockwave, we focus on the real forces moving silver, not the noise. And if you stay with me for the full video, you'll understand why moments like this often come right before massive upside moves that catch the majority of traders completely off guard. Now, let's rewind for a second. Silver crashes hard, fear spreads, weak hands panic, and retail traders start dumping positions. Social media fills up with talk about the bull market being over and silver failing again. This emotional phase is critical because it creates the perfect environment for institutions to act. And right when volatility spikes and confidence is shaken, the CME announces a margin hike. To most people, that sounds boring or technical, but in reality, it's one of the most powerful tools in the futures market. A margin hike means traders suddenly need more capital just to hold the same position. If you're leveraged and already under pressure from falling prices, this forces you to either add cash or get out. And most traders don't add cash, they liquidate. That's exactly why margin hikes often come after big moves, not before them. They don't call markets, they squeeze them. They push out the weakest participants at the worst possible moment. What's interesting is how often this happens near important turning points. Historically, silver has a habit of bottoming shortly after margin hikes, not collapsing because of them. When forced selling dries up and weak hands are gone, the market suddenly has room to move higher again. But this time, the setup is even more dangerous for shorts because the physical silver market is already tight. Here's where things get uncomfortable for the paper market. Industrial demand for silver keeps growing, especially from solar, EVs, and advanced electronics. At the same time, mine supply isn't keeping up. Recycling isn't filling the gap either. So while futures traders are getting pushed out by margin requirements, the physical side of the market isn't loosening. That creates a disconnect, and those disconnects don't last forever. Another detail most people miss is who margin hikes really protect. Large institutions with deep pockets don't care. They can post margin easily. It's the smaller traders and speculative longs who get crushed. Once they're gone, price discovery shifts back into the hands of players who can move size. That's when the market can flip direction quickly without warning. We've seen this pattern before. Silver sells off hard, margins rise, sentiment turns ugly, and analysts start lowering targets. Then, when nobody expects it, silver explodes higher in a matter of days or weeks. The move feels violent because positioning is wrong. Shorts get crowded, liquidity thins, and price gaps higher faster than most people can react. Think about what a crash plus a margin hike really does. It resets the board, it clears leverage, it scares away momentum traders. But it doesn't fix supply shortages, it doesn't reduce industrial demand, and it doesn't solve the long-term currency and debt problems that make silver attractive in the first place. This is why calling this bearish without context is dangerous. Markets don't move in straight lines, they move in cycles of pressure and release. Right now, pressure is building again, just in a different direction. The more traders are forced out at low prices, the more powerful the rebound can become once buying returns. Another angle worth paying attention to is how fast these margin hikes happen after sharp moves. The timing isn't random. It tends to appear when volatility threatens system stability, but controlling volatility doesn't mean suppressing price forever. It usually means delaying the inevitable and concentrating risk elsewhere. And when that risk resurfaces, it does so violently. Ask yourself this: if silver was truly finished, would there be this much effort to manage the market? Would margins need to be raised right after a sell-off? Or would the market simply drift lower on its own? The fact that interventions keep showing up tells you something important is at stake. For long-term holders, this kind of event is more confirmation than warning. It shows stress in the system. It shows that paper positions matter more than physical fundamentals, at least in the short term. And it shows that silver remains one of the most controlled and sensitive markets in the world. Short-term traders, on the other hand, are being shaken out aggressively, and that's usually how big money likes it. Confusion, fear, and forced selling create opportunity. Once that opportunity is absorbed, price behavior changes fast. This is also why patience matters. The biggest silver moves rarely happen when everyone is excited. They happen when confidence is low and narratives turn negative. By the time headlines turn bullish again, the move is already well underway. If you're still watching, drop a comment right now and tell me whether you think this margin hike is bearish or bullish for silver in the next 3 to 6 months. I read the comments, and your perspective helps shape future silver Shockwave videos. As we move forward, watch how silver reacts after the forced selling phase ends. Watch volume. Watch how fast dips get bought. And watch how quiet things get before the next surge. Silence in silver is often the calm before something big. This market doesn't reward impatience, it rewards understanding. And understanding starts with recognizing that crashes, margin hikes, and fear often show up together right before major shifts. What feels like weakness on the surface can actually be strength forming underneath. If this video helped you see the bigger picture, make sure to share it with someone who is confused about what is happening in silver right now. Sharing helps this channel grow and helps more people understand what the mainstream conversation keeps missing. Thanks for watching Silver Shockwave. Stay sharp, stay patient, and stay ready, because the next move in silver might not give anyone time to prepare.